looking at the economic calendar. Okay, I don't have any filters on. So we're seeing it as it would be if you were looking for every possible currency pair under the sun. And Friday the 13th is upon us in about 30 minutes or so from the time of this recording. It's 11:30 p.m. New York time. And we have some New York news. You guys can watch that tomorrow. Be mindful of this. Overnight, we don't really have a whole lot going on for Euro and cable. We have a very small impact German CPI. I don't feel about having volatility on that. It's either going to move on its own or not that anything is going to be attributed to this report, I don't think. Doesn't mean we won't have a setup for Friday. It just means that I don't think it's going to be a catalyst at all for price action. So let's mosey on over to charts. Okay, we have the daily. It's the dollar index. We have a small little fair value gap still residing right in here. Now, we've had institutional order flow on a bearish retracement in here after running these highs. So I want to see what we do after we bounce this up candle here. So it's only buy side delivery. I'm looking for a rebalance with sell side delivery. So we'll be looking for, and that's the remaining portion of price action right in there. So we'll be looking for this candle to drop down and close that in. Now, if we hit this candle's high, which comes in at 92.70, so we're looking for that movement down. That'll free up the opportunity for a rally in foreign currencies overnight into New York. With that said, I want to go over to cable. And I outlined this today on YouTube and talked about it on Twitter. And I mentioned this level here. You guys should know what 3260 is. I'm going to recap it for you here, but I gave the assignment to know what this level is. And for the most part, no one knows what's going on. They have no idea, but they're enamored by how it created the resistance point and then the selling point. And then we're back above it. And look at the bodies, how it's respecting that level. We traded through it. Body, body, all of it's above it. Okay. So we're going to be looking at what went on down here. What was all this about? Okay. So we had this 3260 level I'll talk about. And what was the catalyst down here? So let's jump on over to an hourly chart. And using an hourly chart and our ranges, we have this high down to this low. Inside that range, prices already worked through all of the fair value gap, liquidity void, buy stops, and fair value gap. Okay, so this low comes in at what? 132.68. Okay, 132.68. Inside of this area here, the bottom of that range comes in at what? 132.62. So if price is trading up and we're below it, what's the level it's going to be reaching for? 132.60. This candle's close. 132.64. This candle's close. 132.63. This candle's close. 132.61. This candle's high. 132.59. This candle's close. 132.58. Its high is 132.62. There's a lot of work around that 60 level, but what it did was it went above this short-term high for buy side liquidity in the form of buy stops, and above this short-term high, but more specifically filling the gap beautifully right here on that spike. Price rolls over, trades lower as a result, comes all the way down. What's it doing? Equal lows, sell stops, and all the way back below here for another run on equal lows, sell stops, and to rebalance this inefficiency. Now, think about what it did. It came all the way back down to here just to rebalance that one little portion of price action right there. Now, why is it beginning here? Because this was down. In other words, it's down close, so it's a sell side delivery. Once it traded through this candle's high, it's only buy side, not counting the wicks. It's the down candle we leave, and this is all buy side. And it's rebalanced to this point here. That's a small little portion between this candle's low and this candle's high. It comes down, completely fills that in beautifully, and then it runs away. Now, what I'm going to teach you here, please do not put this on Twitter. These are those things I told you about that are kind of like little quirky things I've picked up in my own studies, and you'll see how cool it is when you start applying it. I want you to take a look at this price action down here. Okay, let me zoom in a little bit. So don't share this on your charts, like with your fibs or anything like that, because frankly, it'll piss me off, to be real honest with you. All right, so we have, let me get this off before it keeps scrolling back on me. Okay, so we have this candle making the low. So this is our swing low. We have higher low to the left, higher low to the right. But overall, prior to that swing low, where's our previous one? It's this one right here. But notice inside this whole price action, it's consolidating, right? Then it drops down. So this is that fake move at Judas swing. Think of this like an Asian range, okay? And price dropping out of that range, run for liquidity, and then rejects and goes higher. Whenever we see, and I'll draw it out for you. Whenever we see patterns like this, when the market makes a low, okay, and the low is formed like this. So it has a low, then a lower low, running it, and then quickly moves away. What I want you to do is just try using your fib on this low, not this one. Because the basis is on a low like this, this was all of a stop run. Okay, they gave them a little bit of a false rally, then come down, knock them individuals out. This is all stop run. So think of it like a wick on a candle. We don't like to look at the wicks. And then it runs away. So focus primarily on that initial low. I'll show you what I mean by that. Okay, here's the lowest body prior to this swing low forming. This is the lowest body candle inside that swing low formation. We anchor it and we draw it all the way up to the body up here, okay? Right there. See how it's laying right on that? Now I'll drop that like that. Now we have the 70.5 and the 62% tracement level and the 79% tracement level right in there, respectively. We scroll forward. Boom. Inside optimal trade entry, but more specifically, look exactly where the 62% tracement level is. The body stops. Now it wicks into it to get that gap, but look at the volume. All the bodies are respecting that 62% tracement level. And then we get this reaction here. After taking sell stops, fair value at optimal trade entry. Okay, so when we look at secondary runs on liquidity at old lows and old highs, and this is an old low, starts to run away, and then comes back down and collapses, taking those individuals out, reaching for liquidity, and then runs. Okay, it's reversed when seen like this. On highs. Don't anchor your fib here when it starts to sell off and you're looking for objectives anchored to an old high. Use the initial high. over here, and then drag it down. When you do things like this, I think you're going to get closer to what would be deemed optimal trade entry, and the free members are not going to get this. I'm not teaching it to them, but please do not put it on your charts, okay? Because invariably, if people start seeing it, they're going to be wondering, why is it anchored here and not down here? And right away, they're going to know that it's probably come from being in the mentorship, okay? But this is one approach of using the fibs that's a little bit off the beaten trail, but it gives you kind of like a more of a precise way of looking at it, because we're incorporating the fact that this is a stop run. So the real anchor point really is over here. So they're averaging in, or average cost for the entry is right here. And this is just a deep discount that may not be a large degree of volume on that run, but more specifically, it's anchored here. Okay, and also if you look at it, it's really essentially almost equilibrium from this high down to this low, which isn't always going to be the case, but when it does, it's even more uniform and symmetrical. So it's a really nice move there. Now, what does it mean going forward? I think we're going higher, and we'll probably see 133.20, 133.15 definitely, I think is likely to happen tonight. 33.20, maybe 33.50. No, it could, but I'd like to see 33.20, 33.15, 33.20 next upside. If we catch a run, it should take us up into 85.90, 33, 85.90, something like that. And if it gets to that point, we could spike right into the 134s. Low to high, measured move, we could get up to target 2. Okay, so basically take the bodies of the candles here to the bodies here, add it to the lowest body here, and let's do that for completeness sake. I'm getting a lot of emails from folks that are enjoying the YouTube videos and telling me that it actually complements their mentorship learning. And I appreciate that. That's really one of the added benefits to you guys having increased knowledge about what I do. So we could see it run to 134.20 or so if we catch a real good runner. I wouldn't expect it, but we might get that going into Sunday and the Monday, maybe, if it doesn't get up there. But I'd like the 33.15, 33.20 overnight. But beyond that, this is the expectation I would have going forward. Okay. And I'm trying to see if there's anything else I want to talk about. Aussie dollar. We are banging up against this bearish order block after rebalancing sell side delivery. I think we're probably going to go up to that 78.45 level. So it's about 15 pips for now. So I'll see what comes by way of that. These are my old notes from the YouTube video, so you'll have to ignore that. And I'm not going to talk about Euro. I'll mention all that stuff over the weekend. I don't think we should be touching that either, at least for tonight. And I want to talk about the forum. Folks are asking me, should they join the forum? Some of you are actually trying to use your present mentorship forum usernames and such to get in, and it's not set up for that. It's actually entirely, totally different platform. So they're two distinct setups. So I'm going to go back over to when I set this up, there was and this is our next question. I'm going to go into the questions in a second, but this is the mentorship forum, and I have it reversed. I messed up. It says the Inner Circle Trader up here, and on the new forum it says ICT Mentorship. So that's actually not accurate. I got to go in there and get this squared away. I thought I was setting it up on the right one, but it's not. This is not mentorship. This is just free stuff. This is the mentorship stuff. So that's the color scheme, so that way you know which one's which. Please don't complain to me about the color scheme over here, because I'm not going to change it. And I'm not going to change this one either. So it is what it is. It works for me, so you have to just do what you got to deal with it. Not to be rude, but I just got to make sure I know right away what I'm inside of. I don't want to be writing anything or presenting anything or putting a link in anything in the wrong form. So this helps me keep it organized by color code. And I don't know what this is. I'm not sure if it's going to show up on their playback, but this little box here is like a ghost image of something that's been on my computer, so I guess I got to reboot. Anyway, let me go down here and pick up where we were on the questions, because I'm a few days behind on that. And we left off with Bitbot. The question is, I am finding it difficult to ascertain when we have a change in market structure versus a stop run and possibly a Judas swing during a kill zone. See the below chart for, okay, Bitcoin, we had to bring that in, huh? At the red arrow below, prior to the rip lower, how do we know this was a Judas swing, rate on stops, and not a change in market structure? At that point, it was a consolidation with lower lows, lower highs. Furthermore, since price ripped so deeply, tagged the sell side liquidity, and has since consolidated in an area, would it be suffice to say our directional bias on this time frame should now shift from long to short? All right, again, let's see what this time frame is. It's saying 60 minutes, so I guess it's an hourly chart. And we're looking at the 3rd of October in this area here. So actually what we're going to do is we don't really pick our trades on hourly charts. So we're going to go over to Daily FX. And this is a chart for Bitcoin. And I'm going to maximize it. Okay. And we have this 3rd is here, right in here. And I want you to take a look at this, because we start all of our analysis on the higher time frame daily, at least the daily, okay? And September, October 2nd and 3rd, right there, this day. Okay, when it's dropping down like that, you're asking me, how do we know if it's a run on stops or a break in market structure and look to go lower? Well, my question is this. What is this right here? It's a fair value gap. What is this? An old high. So we have discount arrays right in here. Price drops down, fills in that right there, and takes off. When it does this, it comes back down into the middle of the last down closed candle, bullish order block. We have a market structure shift right in here with this swing high being broken. This is a long. Now we start looking at what? Are all down closed candles supporting price? And is price finding an inability to go through up closed candles, or is it easily going through them? I would submit that it's easily going through these down closed candles, so it's not offering any bearish order block ideas. And in here, we have 2 down closed candles, and then we trade through it again. Now we're retracing lower. So in here, I would be looking for price to want to get back down into this. There's our order block. Okay, so that's what you should be looking for. Part of a market that's been going higher, went sideways, went down below the consolidation. Why? To gather up sell side liquidity, pick up discount pricing, and rally. Same thing happened here. Sideways, down below the old low, fair value gap, old low, rally away. I think everybody that was looking at Bitcoin knew about 3,000. It's so obvious. I don't trade Bitcoin, but it's just clearly classical support and resistance by itself. But from an institutional standpoint. Right in here, you're asking about why this day here we shouldn't have been looking for the market structure to be called bearish, because you're really focusing on the retracement back into this discount array of bullish order blocks. So we'll drop into an hourly chart. So looking at this in here, we can see on an hourly chart, we have a rejection block. Price comes down below that, clears that up, and now we see price want to trade aggressively the other direction. If we look at this from a low to high, this is optimal trade entry here on an hourly. So really, it's just dropping down to get into a discount array to go higher on a longer term trend on the daily chart. And now is your buy, and you have optimal trade entry in here as a potential entry. It rallies up nicely. And again, consolidation, it drops down to take out the liquidity below the marketplace, take out the sell stops, and then rally away. When we see a market that's defined as bullish, we want to see it trade below old lows or below the consolidation, because then we know that there's a likelihood for it to be picking up discount liquidity. Take the sell stops out of the marketplace, because you're going to be willing sellers to sell at a low price to you. Smart money will buy that up. So when we look at time frames like the hourly, they're subordinate to the higher time frame, monthly, weekly, daily, and 4 hour if you really want to throw that in there. But I don't want to use that so much. I want you to focus primarily on the daily. And I think if you were looking at Bitcoin on the daily chart, it was fairly obvious that institutional order flow has been bullish. It's been in a larger uptrend anyway. Had a nice reaction coming back down to fair value at 3,000, old high, fair value gap, rebalancing, and then sending price higher. And really, everyone was pretty dialed in on this particular asset. 3,000 was just an obvious, clear, easy level to pick, and everybody's been on it since then. So hopefully that's been helpful in terms of answering your question. But it's the same theme we talk about all the time regarding why markets go down below. And just because the hourly's done this, what's more important, the daily or the hourly for directional bias? The daily. All right, so our next question is for how to get 5-to-1 setups. I think that was the basis for the mentorship. I gave you very clear definitions on how to get a 5-to-1 setup. But to be fair, if you want to know a real simple recipe for 5-to-1, you want to trade in the daily buys. Okay, and if you've been paying attention in the free stuff that I've been given on tutorials on YouTube, I gave one simple approach to using what you have learned in the mentorship, one aspect of low resistance liquidity runs, using the daily chart, giving the daily buys, looking for liquidity, using one pattern, optimal trade entry, not even the one I use where it takes into account for a fair value gap, and a stop run with an optimal trade entry. That's my setup. I'm just primarily focusing on the simple optimal trade entry. I'm not going to be giving them any advanced parameters with it. Everything that I've already shown so far on YouTube, that's the extent. I'm not teaching anything more than that. I don't need to. It's a complete system. Now, did I give them the mentorship? No. And I don't know that I have anyone in here that's upset about me doing what I've done. I've actually gotten positive feedback from members, but I watched, I didn't watch, I read a post by one of our members, and I believe he sent me a text, kind of like let me know that he did it. But I read it in response to his post. I didn't feel any negativity about it, and I certainly haven't been through the rest of the forum outside of this area here to see what other people are saying. I certainly haven't gotten any bad press by email saying, what are you doing? But I'm inside the lines I've given both of us. Okay, you as a student in the mentorship and me as the teacher. I gave very generic information by framing all this. What makes it so useful to you is I gave you, like I promised, examples on how to use the mentorship content. Okay, and there's another member that's been with us for a long time, even before the mentorship started. He mentioned that he had an issue still with trying to find his setup. And I'm really creating it with that member in mind, that one particular member that's been with me for a long, long time. He has hit and miss success. And I'm hoping that he can use this as a way of saying, okay, it's really simple. I know what I want to be doing bias-wise. I know what I want to be targeting. It's a complete system, and I'm not going to teach anything more. Everything else is just going to be tutorials and me using what I've already shown every single week and how easy that is to use a setup. Now, that's not my setup, but like I said, these are my tools and I can do that. So how can you use it to get 5 to 1? Now, obviously, you all have the benefit of knowing what the swing traders, position traders, and one-shot, one-kill parameters are. I'm not teaching that in the YouTube stuff. I'm not giving that. Whatever I gave out in the mentorship stays in mentorship, but whatever's in the tutorials, they'll have to dig that out on their own. Okay, and you can see very clearly, I'm even telling them certain things and times in tweets, and they're still asking the same questions that were answered in tweets. So they're not, it's going right over their head for the most part. Only a few of them are really dialed in. So like I said, I could put this stuff on the USA Today page, front page, and then it would largely go unnoticed. But 5 to 1 setups. Okay, if you look at a potential buy, for instance, a optimal trade entry on a 4-hour chart, if you drop down into a 5-minute chart using that same setup, you can very easily get gearing to 5 to 1 as a day trade. If you are looking at a weekly setup and you drop down to an hourly chart for entry, you can very easily get 5 to 1. You want to use about at least 2 time frames in between your setup time frame and your executable time frame. And if you do that, the gearing for 5 to 1 setups are really easy to get. Apart from that, use what I've already taught you in the mentorship, because I've already gave you a lot of detail on how to do that. When we get back together after the holidays in 2018, much like I've done with the YouTube group, I gave one simple model, very easy. It's very, very easy to know what it is specifically, what you're doing using that model. There's a dozen different ways that you can use the mentorship content to create simple little trading pattern-based trading plans, really, to just go after these types of setups. But you have to stay within the lines, and that's the problem. Even with the folks that are still reading old tutorial stuff, they should be doing well, but they're not, because they just don't want to stay with one thing. And 5 to 1 is just simply gotten by larger time frames, those setups, and then using lower time frames, at least 2 time frames lower than the one you see the setup on, and you'll see it's easy to get 5 to 1 like that. All right, the next one here, Arsenal FX. Hey Michael, just wanted to ask you if we could get a designated section in the forum where we can help each other with trade psychology. That's actually a pretty good idea. Pretty sure there is some highly experienced traders on this forum who could give us some advice on how to deal with certain psychological trading issues, or help us spot any mistakes in our trading that we cannot see. Thanks. SQA, you're welcome to set a specific area up on the forum that people can use and participate in. I have no problem with that. I think it's a great idea. All right, one of my responses. Okay, Marcel, a quick question about your New York live session subscription service. Is this going to be something mentorship graduates should be interested in? I don't think you should be, personally. You guys got more information than any of them ever will. I know some of you just simply want to hang out with me, and if you wanted to do that, that's fine. I would rather you didn't, because you have all the content. But if you want to hang out, you want to do that, you're gonna have to pay, obviously. But I'm not trying to press or twist your arm. You guys got more information and more insights than they're going to get. Or should we have already gotten everything from you that we need, and this new service is just for others that never made it to the mentorship? it's kind of like a watered down day trader simple model. All I'm going to do is call the market using what I've already given them on YouTube. So the few videos I've already put up there, that's it. And I'm comfortable with everyone thinking that's all I know, because it saves me a lot of email response and management and from other people outside of our group. I like for them to just think this is all there is to it, and they don't have to ask me 1,000 questions. What about this and what about that? Because if they even came up on Twitter, and not, I'm not teaching it to anyone else outside what you've been taught. Will there be any benefit from it, or should we focus now on paving our own way and not getting our analysis mixed up with yours from the live session, and try not to rely on you anymore? That's really the goal for the mentorship, was for you to kind of like cut ties with me, at least from a hand-holding standpoint. That desire to need me to help you do any of this, that should have been replaced with a vigor for you to want to go in and do it on your own, knowing that you're going to struggle with it for a little while until you get in your own groove. But again, I already know some of you are going to want to sign up for this, okay? And like I said, you're welcome to do that, but I don't really want to cheerlead that on, because I think it would be better for you to not do it, to actually go through the normal process as I outlined it, and just go through your growing pains of what you've been taught. If you watch me in the market, okay, the same thing's going to happen likely. You're going to see something, and either I'm going to either draw attention to something, or I'm actually going to call special attention to a specific level and call a specific move, and it may screw you up in your development. So take that with a grain of salt for those that are contemplating sliding on in, hanging with ICT for the New York session. It may not be a good thing for your development, okay? If this goes on for a while and the free members area, keeps it going, I don't have a 12-month limit on this. It's as long as it's supported. If it dies out, then it dies out. It's no big deal. But the bottom line is do you have any benefit from doing it? It just gives you my opinion about what I think is going to happen in a New York session. And since I won't be actively trading it, because I'm really focusing on London and my own personal time away from everyone else, that way I can freely talk about New York, and they won't have interactions with me like I was able to do when I had the sessions with you guys. I don't see what they're saying. It's just me in my own little bubble. So I get to be me still, but I'm not going to be executing with live trades in front of them. If anything, I'm just going to call the levels and tell them why I think it's going to go there with what's already been taught to them up till now. Nothing else is being taught to them. I might give them like a stop management tutorial beyond that, so that way I have covered that side of the spectrum on trading, but nothing beyond what's already been done. All right, the next one here, Gator Nation. Michael, you mentioned throughout the mentorship that you don't follow traditional or conventional sources of news to gather information. I was hoping you could tell us what sources of news, websites, newspapers, trade magazines you prefer. I think I mentioned this also. I like Investors Business Daily. I like Barron's. I used to have a subscription to Wall Street Journal, but I can't digest all the information. And besides, Investors Business Daily is far better. I read Futures Magazine because there's a few things in there I like to look at for sentiment ideas. And I think that's pretty much it. I don't really look at a whole lot apart from that. I have a subscription to Traders Magazine. Just real simple stuff that isn't really going to make or break my decisions. Just kind of like a Reader's Digest for traders. Some of them are just really waste of print, in my opinion. But I don't really do anything outside of what I already talked about in the mentorship. I mean, it's pretty much that's it. I'm not hiding anything from you. I know it seems like I probably am, but it's because you had built it up in your mind that I have 1,000 different things I'm using. But less is more. But I like the resources I've just quoted. All right, Hacksaw. Working on the euro dollar one shot, one kill for this week. Watched the impulse from Sunday open and then entered short at 117.80 on the 4-hour fair value gap yesterday. So now I am either looking at a market maker buy profile from Sunday to Thursday, and this level 1720 is the low risk buy, or looking Tuesday to Thursday, it looks like market maker sell model or sell profile, and I've nailed the entry. It's hard to imagine being this close and they won't nail the sell stops below 116.95. Also into the trade psychology here of what's a serious retrace or change in direction. I think I've already just answered this with BitBot's question. So I've been watching a final target of 115.85. So we'll take some off before then, most likely at 16.95. Yeah, I think you're just sharing something with me here, which is fine. But I think the only real question I think you posed was what I just responded with in regards to BitBot. How do you know what retracement is a retracement for liquidity and not an outright reversal or change in market structure? And it's based on what the direction is on the higher time frame, because that's going to be the dominant directional bias. So if you know that it's dominantly on the higher time frame bullish, we have to immediately assume right away that any low that gets taken out or consolidation that gets traded down below, they're going down for sell stops. And don't be afraid to buy that. Everyone else is going to see that as weakness and will be afraid to buy. They'll be wanting to short it. You want to trust the higher time frame. Okay, in reverse, we're going short. All right. Michael, I'm going through my notes from September live session, and I made a note on September 20th, 2016 FOMC day to ask about how to use the Asian range for projections on days after the day it forms. Tuesday's Asian range used for projections on Wednesday or Thursday, for example. Could you explain further how and when you do this? You're actually using the projections of the Asian range the day of. So in other words, like tonight, right now it's 12:08 New York time on Friday morning. So the Asian range is now, in my opinion, my interpretation, is complete. Okay, let's go over to the charts. I'll give you an example. Okay, this was yesterday. Last night we were trading, and here's the Asian range. Okay, right in here. Let me take some of this stuff off here, just so I can clean it up. Make it a little bit easier for you guys to follow along. Get this off here, and this off here. Okay, so we already arrived at the model of this being an optimal trade entry using the low off of here, not this one, over here. Okay, and we drug the fib all the way up to here. Okay, this projection down, the Asian range, if we look at the bodies of the candle, okay, at the lowest body here up to the highest body right there. Okay, for this move down here, the day of the Asian range, you're taking that range and projecting it down. So there's 1, 2. Now, does anything line up with that over here? There could be potentially an order block, but look past that. We have equal lows. So now we know that there's probably going to be a retracement below that because it's Candyland. Okay, we have equal lows. Now we have 3 standard deviations on the Asian range, exactly with that. So we know we can potentially go below it one more time. Okay, so we have that level. With this projection here, we have an old low here, so we can sweep that. Then we have old low here. And as price drops down into deeper discount arrays, like this one here, Takes us into an Asian range low over here and below it. Right in here, we have a rejection block. The lowest close is 31.38. Okay, and put a line on that. So it could reach for 31.38. And we have the projections down here. So we have several different things confirming and overlapping with. And remember, the optical trade entry is right there as well, right at that level here. So we have the projection of the Asian range, the day of trading, and we have, let's keep this on the chart, and we'll go back up to hourly. Okay. Right there. So we have this low and this low. This higher low during the consolidation, we're going to anchor our fib on that and watch what happens. Lowest body, drag it up to the highest body, right there. Okay. We have the 62% retracement level right on the bodies, and look how close it is to the projections with the Asian range. That's a lot of confluence supporting an idea like this move here. So we're using the day of, like right now, we have our Asian range, and we drop down to a 15-minute time frame. Okay, so we have our Asian range here, and so far we have very tight, narrow range. Okay, I would prefer it drop down one deviation first, come down, clear out these equal lows right in here, just by a little bit. It doesn't have to be a whole lot. If it does do something like this, say it drops down, completely fills in this void, I'd like it to go to this close right here, and that way I can look at this as rebalanced because it did it in one single candle. So we can use the close at 132.12. Let me add that on. Okay, so we could see that occur with that. Drop down there. So we could see it spike a little bit through it. That'd be 1, 2, 3 standard deviations. Right there. And incorporating the fib for discount to premium. Body. Up to the body. Right there. Highest body right there. 62% retracement levels right here. And that would take us a little bit deeper into this void. It's almost about 50% between where I'm identifying here down to here right there. It's about 50% of that. So we could possibly get down to 70.5. I'd rather it didn't do that, really. Yeah, I'd rather it didn't do that. It would make better sense for it to either go right from where we are and start running up and then hit that objective of 33.20 in here, and then maybe make a run lower on that after it hits that first. So I would look 33.20, 33.15, And if we get some weakness there, then we can start looking for these projections down on the Asian range. Otherwise, on the upside, we have one standard deviation here, and 2 standard deviations puts us right in around that 133.20 level. Could spike up and could touch 33.25, but I'd rather hit 33.20 and be done with it. So it could do this. It could run up, hit that, and then start to sell off, and then kind of clean this up a little bit in here. Maybe, not necessary, but maybe. But that's how I could look for opportunities with the Asian range. But it's the day that the Asian range is created, you do your projections. It's not like a previous day or anything like that. Okay. And that's going to be it for tonight. I will catch up after. I'll do some more on the weekend. So I'll do a weekly recap, and then we'll get caught up some more on the questions. And until then, I wish you good luck, good trading. Have a pleasant weekend. I'm not going to be doing anything tomorrow, technically. I have a busy schedule with my son at school. He's got some things he's doing there. And after school, I have some other things I have to take care of with my daughter. So it's a lot of family stuff this weekend. But I'll get to you guys in response to more questions. And I'll give you a weekly recap. That's going to be it. I'll catch up with you guys on Monday. Till then, wish good luck and good trading.